Okay, so have a little idea here. My take on this inflation and how to solve it, for the record, I'm going to put this out, is something I think altogether different than what the mainstream is thinking. And this guy, Ted Oakley, on Kitco News today, he had a very interesting take on it that I really do relate to. Let's listen.
The Federal Reserve has shifted their stance from an easy monetary policy to that of a more hawkish, more defensive, more contractionary monetary policy. Do you agree with that consensus view that the sell-off was the Fed's fault?
Well, it's partial, right? Because what happens is the Fed always runs it in the ground, so to speak. And the only way that they know how to control inflation usually is to throw you into a recession, which kills demand. I think one of the things they're missing right here is probably wondering if the supply side for this inflation piece is more to blame than the demand side. I think there's something to that. If that's the case, they're doing the wrong thing for sure.
So that's a take I really find interesting, and I've been thinking along those lines for a long time. I did a video explaining kind of my take on it several months ago. And the long and short of it is U.S. productivity over the last 20 years has been incredibly stagnant when compared to the average. And if we need proof of that, we need to go no further than the Bureau of Labor Statistics, which, they do good work sometimes. Of course, in this report here, they put a little spin on it, which I'll get to. But this was written in April 2021, so only about a year ago. Okay. And here we have a chart, and as we can see the title, the U.S. Productivity Slowdown and Economy-Wide Industry and Industry-Level Analysis. And here on this chart, we have the average since 1947 at about 2%. Now let's get started first by saying what productivity growth is. This is the amount of output in dollars per labor hour, or something like that. It's units of labor per person, per hour, something like that. I think it's per person, whatever it may be, per day, but it's a certain amount, how much output is being produced per hour of labor. So what they do is they take the output, they subtract the inputs, they come up with a number, and then over year, in a healthy economy, that number should grow. It should grow, according to this, over an average of, since 1947 to 2018, that's including the last 20 years, which were low, by the way. We had about 2 and 2.1% labor productivity growth year over year. Now, I'm willing to guess that if we took the last 15 years out of this, that would be slightly higher, maybe 2.5%. Who knows? But what does that mean? That means less goods and services in the economy. So that's a big problem, and there is no discussion. So even if demand and, the increased money supply, the higher demand for goods and services is part of the equation, the supply side, or the supply push inflation, is also a component of it. And there is absolutely no discussion whatsoever about no serious discussion about solving the supply side of the equation of inflation. Now, one thing a lot of people say is, in a society where more and more people are moving into retirement, that should have a deflationary impact on prices. given that people who are retired tend to spend less. And they aren't producing anything, generally speaking. They're out of the economy. They're not working. They're not taking part in any productive enterprise, at least not a full-time productive enterprise. At the same time, they're not spending as much money because they're on a fixed income. So that's the general reasoning among most economists that I'm seeing, is that as we get more and more retirees going into retirement, that should lower demand significantly and very noticeably. But there is a problem with that thesis. The average baby boomer is worth 12 times, has a net worth equivalent to 12 times that of a millennial. The baby boomers are heading into retirement flush with cash. Now, the way I see it, just to add a little psychology, here's where the macroeconomists miss an important component. Let's not look at the sort of macroeconomic equations and formula that are typical. Let's look at the psychology of this generation, the baby boomers. I love to rag on baby boomers, and I think they deserve it. And this is nothing personal to any specific baby boomer, but as a generation, they inherited a prosperous economy, a prosperous country, and they had to actually go through little suffering. They were given everything they wanted, everything they needed. The worst they went through was the 1970s in terms of an economic downturn. The 1970s pales in comparison to the 1930s and 40s. So they generally had an easy life. They were generally made a lot of money, and they generally spent a lot of money. They were also very productive, as we had a huge productivity boom starting in the 1970s and going straight to the 1990s, early 2000s, actually mid-2000s. That was the baby boomers. But what I'm getting at here is that this is going to be an atypical retirement generation. In the beginning of their retirement, I think the baby boomers are going to be the primary driver of demand in this economy because they have the most money. The millennials and the Gen Zs, the Gen Xers, you might as well lump with the baby boomers at this point. The millennials and the younger generations, they have no money. They're going to contribute very little to demand. Meanwhile, the baby boomers have all the money. They have multiple houses. They're going on vacations. Okay, they're spending money, at least at first. So I would say we started to see a massive wave of retirement starting with the COVID recession. Let me rephrase that. The lockdown recession. Okay, that's when a lot of these baby boomers retired early, and we're going to see that trickle out. That's one reason why inflation jumped, among other reasons, besides the fact that the fiscal spending increased disposable income quite a bit. At the same time, baby boomers are retiring. Productivity is declining even further. The productivity numbers for this last year were terrible. I'm going to look that up right now, and let's take a look at it. So I got productivity growth here for 2021, 1.9%. That's with the base effects of 2020 taken into account. So I would say that's, it's definitely stagnant. It's definitely below the average, and I would say if it wasn't for those base effects from 2020 when the entire economy was shut down, your productivity growth for 2021 would be a little bit lower. Maybe I'm wrong there. I don't know. I have a feeling that might be kind of a misreading of it. But 1.9% in 2021. And 2021 was, by all accounts, a fantastic year, at least in the asset markets. Okay, but productivity growth, I mean, if the if the Dow Jones Industrial Average goes up from, what was it, in the mid 20s, high 20s, goes up to 35. I don't know. It was like in the mid 20s or something, or 25. It goes up to 35 by the end of the year, 10,000 points, but you only have a 1.9% productivity growth. I would say that's lacking. That's a little bit disappointing. Okay. So what I'm getting at here is, by and large, I think the bigger problem in the economy is not the demand side, but rather the supply side. Now, why is that? My humble opinion, being one who leans more towards Austrian economics, is going to be the regulatory burden in the U.S. Businesses are burdened immensely in the United States. Here we have a number of regulations, I guess, in the CFR, steadily growing. Okay, from 1977 to 2012. Mind you, this is a 2016 article. Okay, imagine how much it's grown since then. I mean, perhaps during Trump's years it slowed down some, but it still grew. The tax burden on the average, what's this? Cost of regulatory accumulation per work country. So this is not sure what this chart is. U.S. regulations. Okay. U.S. regulations, if it were GDP, nominal GDP. $4 trillion in regulatory, I guess, fees taken in by the government. That that number is subtracted directly from the productivity. Okay, when a company pays regulatory fees and taxes, that's money that they could spend producing products and growing the business and even paying their workers and providing them with benefits. But instead, the money goes to the United States federal government. You see, in this report here, which I'll pull up again, by the BLS, somewhere in here, let me find it real quick. Here we have, with the BLS, a government agency. Thinks about it. I'm going to have to increase see if I can zoom this in. Okay, so it says, not only has the productivity slowdown been one of the most consequential economic phenomena of the last 2 decades, but it also represents the most profound economic mystery during this time. How mysterious? It's not mysterious to me why the Bureau of Labor Statistics would find this phenomena mysterious. Obviously, they cannot say that this is partially, at least, because of a regulatory burden that is increasing. We have an increasing regulatory burden, which is sapping productivity from the economy. All the while, we have the number of retired people increasing to 22% of the population, according to this. Right? Oh, no, this is by 2250. So right now it is 16%, but it's ever increasing, and it's going to increase a lot more as they project in the next 10 years. Okay, that's going to be maybe one of the largest increases in the retired population in the history of the United States. All the while, the regulatory burden increases. So we got fewer people participating in productive activity. Meanwhile, at least for the next few years, they're going to be spending more. I would suspect from a psychological standpoint, knowing and understanding this boomer generation, having studied it more than I would have preferred to. Okay, trying to figure out why they're so fucking bad. Why are they so fucking pathetic? And what it is they are the weak men in Neil Howe's Fourth Turning that are making the hard times come about. They were the ones that were handed a prosperous, fully efficient, fully working economy and society by their parents who went through all the hardship. They didn't experience any themselves. So what are they going to do? They're not going to save money for the first several years of their retirement. They're going to spend like crazy because they don't have any concept of saving money. You can just look at that. They have no concept of fiscal responsibility. So not to be too harsh, okay, but I can see a trend in this baby boomer generation as it retires spending money more so than previous retired generations, at least at first, until they start seeing that their their spending is not sustainable. So that's going to increase demand. In fact, there's going to be more spending, more demand pull inflation as these people retire. Meanwhile, the supply side is going to continue to deteriorate. And therefore, if the Federal Reserve thinks that just increasing interest rates a quarter point, a half a point, whatever, per meeting, even if they put us into a recession, I don't know if that's going to be a deflationary recession. It could be an inflationary, at least somewhat inflationary recession. Then what happens when we get out of that inflationary recession? If we have actual stagflation and we come out of the stagflation, this is what happened in the 70s. We had recessions. The inflation went down a little bit, but still stayed high. And then we came out of the recessions and inflation went to the moon, which made the economic recovery unsustainable. So we're going to have, I think, this period of high inflation and periods of recession with some booms. And then finally, once these boomers finally figure out that they can't spend money like there's no tomorrow, then boom, deflationary in a big way. So that's my thesis. And I think that, and I've said it before, I think that the supply side has a lot more to do with the inflation than the demand side. The thing is no one in the mainstream or in the institutions wants to admit that the government that they rely on, that they are subsidized by, and that they partner with are the biggest part of the problem. And no one's going to fix it. You see, governments can't downsize themselves. They have to fall apart. They have to crash and burn. And that's probably the only thing that's going to get us out of this pattern. But that's a different topic for a different day. But this is my thesis. This is my thought. Quick video. Let's end it there. I'm out.